In this video, I'm going to discuss two different approaches of using free cash flows to determine the value of a company, and then we're going to work through an example of calculating the intrinsic value per share for Coca Cola. So the free cash flow to the firm is the cash flow available to all the firm's suppliers of capital. These would include common stockholders, debt holders, and preferred stockholders. And it's the cash flow available to them once the firm pays all its operating expenses, including taxes, and then any expenditures it needs to sustain the firm's productive capacity. So think of things like replacing equipment that's worn out, building new buildings, new locations for businesses, things like that, things that the company needs in order to maintain and increase its operations. The expenditures include what is needed to purchase fixed assets and working capital, such as inventory. The firm's suppliers of capital include common stockholders, bondholders, and preferred stockholders if the firm has preferred stock outstanding, and most firms in the United States don't. The free cash flow to the equity, FCFE, is the cash flow available to the firm's common stockholders once operating expenses, including taxes, expenditures needed to sustain the firm's productive capacity, and payments to and receipts from debt holders are accounted for. And we're going to see later on, when we look at Coca Cola, that the firm can take on debt, and that debt is considered to be available to be paid out. The proceeds of it are considered to be available to be paid out to the stockholders of the firm. And in the case of Coca Cola and other firms, over the past decade and a half, they've actually done that. They've taken on debt, and then they'll take the proceeds of that debt and they'll pay it out to stockholders in the form of stock repurchases. So there are two ways to estimate the equity value using free cash flows. The first is that we take an entire firm and all its free cash flows are discounted, with the relative discount rate being the weighted average cost of capital. And so for the free cash flows to the firm, we use the weighted average cost of capital as the discount rate because it reflects all the firm's sources of capital. The value of the firm's debt is then subtracted to calculate the equity value. Using the other approach, the free cash flows to equity, we only discount back the cash flows available to the common stockholders, and our discount rate for that is different. It's going to be the required rate of return on equity, or the cost of equity, because we're only looking at the cash flows available to those investors of the firm. The free cash flow to equity approach is a more direct method of estimating equity value. However, there's some situations in which we would not want to use that, and instead we would want to use the free cash flow to the firm. The two general cases are when the free cash flow to the firm free cash flow to equity is negative. And for a company in its introduction stage, this is often the case. A company doesn't have enough, is not generating enough cash from operations to pay for its operations, and so they're having to borrow more money in that case, in many cases, in order to sustain the company. And in those cases, FCFEs are often negative, and so they wouldn't be useful in valuing the firm. The second case is where the firm's capital structure is unstable. If the company is taking on a lot of debt every year, or if they're paying off a lot of debt every year, that can cause the FCFE to not be accurate for the long term. And you'll see why when we get to the example of Coca Cola. So there are different approaches to calculating the free cash flows to the firm and the free cash flow to equity. The approaches I'm going to show you start with net income. There's another common approach that starts with the earnings before interest and taxes. They should give you approximately the same outcome no matter how you use it, no matter how you use them. But this approach starts with net income, and then we add back non-cash or cash flows that would non-cash expenses or cash flows that would actually be paid out to the investors with this approach. So what I have here, it says the free cash flow to the firm is equal to NI, net income, plus non-cash charges. So our non-cash charges are generally depreciation and amortization expense. And we add those back because they're not cash, and so they're deducted out of net income, but then we want to add them back in because those are actually cash flows that are available to be paid out to investors. We add back interest. So up here we have INT. INT is the interest expense, because that is a cash flow that's paid out, but it's paid out to an investor. It's paid out to bondholders or to lenders of the firm. We multiply that by 1 minus the tax rate, because whenever it is paid out, it's also tax deductible, and so we want to adjust that cash flow for that reason, so we're not adding back in the taxes that were paid out there. The next is the fixed capital investment. So these are going to be our capital expenditures. This is the money that's invested for the purposes of maintaining or building the productive capacity of the company with the fixed assets of the firm, like equipment and building and land. And then finally, working capital investment. These are investments in inventory and accounts receivable, for example, short-term or current assets. And then we subtract out in our calculation the cash that we're getting from accounts payable and accrued expenses. So we calculate the free cash flows to the firm, and then we calculate the value of operations as the present value of the future free cash flows to the firm, discounted back to today at the weighted average cost of capital. So what this equation says is that the value of operations is equal to the free cash flows of the firm for times 1 through t, which is our terminal value year, our terminal year. And the terminal year is where the growth rate is expected to be constant. In our example, we're going to say that Coca Cola is already a constant growth firm, and it really kind of is. If you think of it, Coca Cola has saturated the market with their products. There's not really any place that they could go in the world where they don't already sell their products, and the growth rate of Coca Cola is dependent upon the increase in the population and inflation for dollar amounts of sales. And so we would consider them a constant growth company because of that. And so we'll use this equation here that says the value of the firm at the terminal time period is equal to the next free cash flow to the firm divided by the weighted average cost of capital minus the growth rate. So to go from the intrinsic value, to go from the value of operations to the intrinsic value per share, we take the total intrinsic value of the firm is equal to the value of operations plus the value of non-operating assets. Non-operating assets are assets that are owned by the firm but not used in day-to-day operations. These often include short-term investments, marketable securities, and long-term investments. So the first two items there, and sometimes the third, is just excess liquidity that the firm has. So if the firm has extra cash or extra liquid assets, they might invest it into things like marketable securities or short-term investments. And if they expect to have that for longer than a year, sometimes they'll also invest in long-term investments. But they're assets the firm has that are not used in its day-to-day operations. So that's the total intrinsic value of the firm. The intrinsic value of equity is equal to the total intrinsic value less the debt of the firm. And what I mean by debt here is the interest-bearing debt of the firm. So these are the liabilities that are to investors. And these represent prior claims to the value of the firm before the stockholders receive their value. The intrinsic value per share is the intrinsic value of equity divided by the number of shares outstanding. And just as a reminder, when we talk about intrinsic value, we're talking about the value that's calculated from the fundamentals of the firm. And it is separate from the market value of the firm, which is the value that we observe in that the investment is being traded at in the marketplace. Going on to the free cash flow to equity holders, we calculate the free cash flow to equity holders, or equity, as the net income of the firm plus the non-cash charges that we talked about before, depreciation and amortization, minus the fixed capital investment, minus the working capital investment, plus the net debt issued. And what I have here, NI is net income, NCC is non-cash charges, fixed capital investment, and I mentioned this before, that fixed capital investment are the capital expenditures of the firm. The working capital investment, I'll show you how to calculate this again. And then the net debt issued is the amount of debt issued by the firm less the amount of debt repaid. And let me actually add one more thing here. What net debt is. Net debt is the amount of debt the firm has, the amount of interest-bearing debt, less the amount of cash the firm has. And so we consider cash a negative debt because it could be used to pay the debt off of the firm. So let's say that I have $50,000 in debt and I have $25,000 in the bank. I would be considered to have $25,000 in net debt because I could take the $25,000 in the bank and pay off $25,000 of my debt. The intrinsic value of equity, so above we talked about the intrinsic value of the firm first. So the intrinsic value of the equity is equal to the value of non-operating assets plus the present value of the free cash flows to equity holders. Our calculations here are the same as they were above, except the cash flow is FCFE instead of FCFF. And the discount rate is the cost of equity, or the required rate of return for equity, instead of the weighted average cost of capital. And then down here we again have our constant growth model, which is what we'll use for Coca Cola. Our intrinsic value per share is the intrinsic value of equity divided by the number of shares outstanding. So I'm going to go over now to the spreadsheet and for Coca Cola. So we're going to start up here. I'm going to start off with net income and then our non-cash charges. That's our depreciation expense here. Then our interest expense, our tax rate, our capital expenditures. I'm going to show you how to calculate the net working capital. And so let's start there. The net working capital for a firm is equal to its accounts receivable plus its inventory minus accounts payable minus accrued expenses. And for Coca Cola, it's kind of strange because their net working capital is actually negative. This is because Coca Cola's been around a long time. They are, kind of a mature company. They are gotten very good at managing their receivables and their inventory and their accounts payable. And so what we see here is that the accounts payable represent what they owe their suppliers for their inventory. Coca-Cola actually has less inventory outstanding than it does accounts payable. So it's selling its inventory faster than it owes the money back to their suppliers. And so that's a source of cash for the company. And then Coca-Cola has quite a bit of accrued expenses out here as well. And so again, these are sources of cash that don't come from investors for the firm. So they actually have negative net working capital in 2023, and also negative net working capital in fiscal year 2022. The one thing that did happen, though, as you can see, is it becomes less negative from one year to the next. So even though it's a negative number, between fiscal year 2022 and fiscal year 2023, Coca-Cola had to make an investment, a cash investment in its working capital because it had less accounts payable, and that's really where the change comes in here to count on as a source of cash. So to calculate the net working capital investment, we take the net working capital at the fiscal year end, the most recent fiscal year end, and subtract out the amount from the previous fiscal year end. And that gives us $244 million for Coca-Cola. That's the amount they needed to invest in 2023 in working capital. So now to calculate the free cash flows to the firm, we take the net income. And I'm just using that equation that's in your notes. And I'm going to add back the depreciation expense. And then I'm going to add back the interest expense, and I'm going to multiply that by 1 minus the tax rate. So now I'm going to add back in I'm going to subtract out the capital expenditures because that's a cash flow necessary to maintain the company. And I'm going to subtract out the net working capital investment. And again, this is a cash investment that needs to be that had to be made to maintain the operations of the firm. So we get free cash flows to the firm of approximately $11 billion for Coca-Cola in fiscal year 2023. Now moving on to the free cash flow to equity holders. I'm going to pull up that equation really quick. So free cash flow to equity holders is equal to net income plus the non-cash charges minus our fixed capital investment minus our working capital investment, and then adding in our net debt issued. So our increase in net debt here, and I'll just show you how it's calculated. Our net debt at the end of fiscal year 2023 was $30.881 billion, and at the end of fiscal year 2022 was $30.648 billion. So there's a small increase there from one year to the next, meaning that Coca-Cola had an increase in its net debt, and those cash flows are available to be paid out to equity holders. So for the free cash flow to equity, I'm going to start with net income. I'm going to add in the non-cash charges. I'm going to subtract out the capital expenditures. I'm going to subtract out the net working capital investment. And then I'm going to add in the increase in net debt. And so we get a value here of 99.79. The difference between the free cash flows to the firm and free cash flow to equity is generally the amount paid out to the bondholders of the firm or the other lenders of the firm. Now we're going to move on to calculating the value of operations for the firm. We're going to start here with the free cash flow to the firm approach. Our free cash flow to the firm, which we calculated down here, was approximately $11 billion, a little bit more than that. And now we need to know what the cost of equity and the weighted average cost of capital is for the firm. So Coca Cola has a beta of approximately 4.59. The risk-free rate for the company is 4.39%. Well, not for the company. This is the risk-free rate. It's the yield, currently the yield on the 10-year U.S. Treasury. The market risk premium is currently 4.6%. And so our estimated cost of equity is equal to our risk-free rate plus our beta multiplied by our market risk or our equity risk premium. And that gives us an estimated cost of equity of 7.09%. Currently, the yield on Coca Cola's 10-year bonds is 5.43%. The market capitalization for Coca Cola right now is about $254 billion. The total debt that Coca Cola has is approximately $44.5 billion. So the total capital for Coca Cola is $298.559 billion, or right around $300 billion. Using those values of market capitalization and total debt, we get a weight of equity for Coca Cola at 85% and a weight of debt at about 15%. This results in a weighted average cost of capital of 6.7%, and this number is calculated as the weight of equity multiplied by the cost of equity plus the weight of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. I'm assuming a constant growth rate here of 3%, and let me explain where that number comes from. When we think about a company growing like Coca-Cola, the long-term growth is going to be restricted to the growth in the population and inflation. The long-term inflation rate in the United States is about 2%, and the long-term population growth rate in the United States is about 1%. So combining those together, we get a growth rate of about 3%. So our value of operations here will be equal to, and the formula is the free cash flows to the firm. So we calculated those for the most recent year, fiscal year 2023, multiplied by 1 plus the constant growth rate. So that's my numerator. My denominator in parentheses is going to be the weighted average cost of capital minus the constant growth rate. And that gives us a value of operations of $306.570 billion. So that is the amount we would sell Coca-Cola for, probably, if we had to sell Coca-Cola. To that, we're going to add in the value of non-operating assets. So Coca-Cola has $4.3 billion worth of short-term investments and $21.6 billion in long-term investments. And these are investments that are not used in the day-to-day operations of the firm, and so they're not part of the operations of the firm. So we're going to add those in separately. So our value of non-operating assets is $25.941 billion. And so our total value of the firm is equal to $306,570 plus $25.941, which is $332,511 and 34 cents. The amount of debt, the interest-bearing debt that Coca-Cola has is $44 billion worth. And so we're going to take the total value of the firm and subtract out that $44.5 billion. So we get a value of equity for the firm of $288 billion approximately. So our intrinsic value per share is going to be the value of equity divided by the number of shares outstanding, or $66.84. Going over now and using the FCFE approach, we calculated the FCFE at 9979 for the firm. So the value of equity operations would be using that same constant growth formula that we used before, the FCFE for the previous year multiplied by 1 plus the constant growth rate. And that's our numerator. And then we're going to divide that by the, in parentheses, the cost of equity minus the constant growth rate. And that gives us a value of 251,507.57. And to that we're going to add the value of non-operating assets. I'm going to go back down here and grab those. So that was 25.941 billion. So the total value of the firm's equity is equal to 277,448.57 cents. And that gives us an intrinsic value per share dividing that by the same number of shares outstanding of 64.40. So currently, as I type this, Coca Cola has a value per share of about $60. So either the valuation is a little bit off in the marketplace, or there's something small different about what we're looking at in this estimate and the numbers in the marketplace right now. So it could be a couple of things. It could be that our cost of equity is too low here. Our required rate of return is too low, and that could have an effect on the value of the firm. And this would be something to consider. The cost of equity at 7.09% is kind of low relative to the yield on Coca Cola's 10-year bond at 5.43%. Usually we would see a little bit of a bigger difference between the cost of debt and the cost of equity there. So we might consider that, especially since we use the capital asset pricing model here, and that often gives us maybe a little bit lower value for the cost of equity than we'd normally suggest. So if I adjust this number a little bit, let's just see what happens to the the price per share here. If I increase this to, let's say, 8.5%, which might be a little bit more reasonable number, there we get actually a lower price than what it's currently selling for. It drops it down to about $50 a share. If I mess with it a little bit, then we get at 7.5%, we see here that we get really close to the current price of the stock at about $60 a share. But that can be one of the things that affects the value of the company. It could be that the growth rate may be a little too high, or in combination with a higher cost of equity might be a little low, and that's something we'd probably want to research and think about. But this is the general approach using the free cash flow to the firm method and the free cash flow to equity method of calculating the value of a stock.